Let's get to work. So we have a lot of stuff to talk about. As you guys have probably noticed, we have been in essentially a bear market for the last couple months in the U.S. stock market. It doesn't really matter how you look at it, whether it's from market indexes or individual stock action. We are essentially in a bear market, and we have been for at least a month or two. I would say really kind of started showing signs in November, and then a few weeks later, we really started to see it. So we've been a couple months into this, and I want to talk to you guys today about how to survive and then thrive as how to survive and thrive as a day trader when the market is dumping like this. It may feel crazy to you, like what's happening right now. A lot of you guys, especially new traders, like you just haven't been through a lot of this stuff. But in like reality, like, markets are markets for the most part. There's not really that much of a difference in this market than what you would see in like a runaway bull market. There's no difference. In essence, it's just turned upside down, right? It's just turned upside down. But there are tactics and strategies that we have to be aware of when these things happen, so that we can move what we do into more profitable zones. So, like, for example, like if you're using just very, very bullish strategies, and you have, like, say you're a breakout trader, and your strategy is to buy breakouts, for example, like you draw horizontal lines on charts and so on and so forth, and that's your thing. Well, like, if you were doing that, right, like you would lose every single time the last, I would say 3-4 months. Like that setup doesn't exist anymore. And so like you're seeing like right now, like people that were like really successful small cap traders, like they can't even win on one trade right now. Why? Because if you're a one trick pony in this market and you're doing something that works in bull markets, it doesn't really translate to bear markets. So we're going to talk about those kind of things today. We're going to talk about what not to do in a stock market correction. We are in the teeth of a correction. Now, I do believe we're probably, I wouldn't say closer to the bottom than the top, but we're getting there. Like, I don't think this is the beginning. We're probably closer to the downside, meaning that a lot of stocks like have already dropped like 50, 60, 70%. I was reading an article on Bloomberg that said, there's like, this is the highest number of stocks in the NASDAQ that have dropped more than 50%, like, ever. So we're getting into those kind of zones where, probably a lot of this will lighten up, but we want to talk about how to grow your trading account, short selling stocks, meaning I'm betting on stocks that go down, that, just like you bet on them to go up, and right, you trade it to the long side. You can turn that frown upside down and short stocks. And that, frankly, I don't think I've probably taken a handful of long setups in any given week. So, we're talking about for the last 2 months, like, I don't think I made any money on the short side. I don't think I made any money on the long side. So that's something that we want to talk about. Like, how the heck do we actually go out and short these things and make some money? And then, of course, how to manage risk during volatility. Like, how do you know when the market gets wild? It's our natural inclination to, right, go for the home run, because we think this is like how we're going to like make our mark, right? We're going to make all this money, but that's really a misnomer. Like, we can't really do that, because when the markets are wild, like you have more fluctuation, you end up actually getting stopped out quite a bit. So you want to actually be reducing risk during these times and letting the volatility pay you. And we'll talk a little bit about that. And then we'll get into like how to know when you're supposed to be long the stock, how to know when you are supposed to be short a stock. So what I mean by that is, right, like, on any given day, you could get up and it's like, okay, like, what are we supposed to do, right? In this particular market, there has been a handful of strategies that have been working day in and day out on both sides. And so we'll talk a little bit about that. And then we're going to get into a little bit about how to control our emotions. For those of you guys that actually have been doing a little bit of trading, but you're having trouble controlling your emotions, that discipline just seems to come and go. I'll give you a couple tips on really how to manage that. Because beyond like a strategical strategy, right? Where like you get up in the morning, you have routines and checklists of things that you do and very, very specific things that you do when you look for your trades. Beyond that, you have to have the discipline to actually go out and follow your plan, which a lot of people don't. I've met thousands of students over the years, and I would say at any given moment, every single one of them have had a problem with, and I have problems with them too sometimes, of following your plan. Like sometimes you know what you're supposed to do, but you're like, you still can't do it, right? You just don't do it. And that's going to be really important. So the agenda for today, we're going to talk about common issues that traders are facing in the current market, what not to do in a market correction, how to manage your risk correctly, when to long, when to short, and then of course, master all market conditions using our 60-day course. We'll go into a little bit of that. So for those of you guys that don't know me, I'm the head janitor of this place. I'm the founder of Bulls on Wall Street, the big boss. I have been trading stocks professionally now. So I started like trading full-time in 2007. I quit my job end of 2007, right when the recession hit. I started Bulls on Wall Street in 2008. And I've been teaching people how to trade like literally ever since then. I was a young man when I started this company. I've been teaching people how to trade like ever since there, while trading live in front of them using a momentum-based trading style that I think is probably one of the best ways for retail traders to trade, because it's a trend trading based strategy where you don't have to have like a bajillion dollars to trade, but you're also not going to get sucked into trading small caps and all this kind of stuff. Because you know what, a lot of times, like what happens, like when people are new, is they're new and you go searching for information, and the shittiest but the most enticing marketing is always geared towards penny stocks and small caps and things of that nature. And so a lot of people actually get started, and then they have a saying like, right, like 90% of traders like blow up an account or lose their money. A big portion of that is that so much of the marketing is just geared towards funneling people into penny stocks and stuff like that, where you can't win money, that people end up losing the money, and then they learn their lessons and learn properly anyways. But that's something to just kind of be mindful of. Damien, there are, and if you think about, so Damien asked a good question, like, do you trade stocks or mostly options? There are no older and veteran penny stock traders or options traders. I met traders all over the world. I've met 3 good options traders. Like, they don't exist. It's fine for like very, very specific strategies here or there, but options is the same thing as penny stocks. It is geared towards people that have very, very small accounts, $500, $1,000, $2,000, $3,000, and enticing you to say like, hey, you can make all this money because you're going to have all this leverage. And look, this one options trade went up 1,000% and so on and so forth. But yes, for every 1,000% options trade you have, you'll have like 60 losers where you lose all your money on them. And so options, penny stocks, small cap stocks, there's a time and place for them, but there's not a time and place for them when you're brand new, because the marketing is geared towards people that don't have any money and don't have any skills in trading, and they funnel them into that because you lose your money first in those always. Where like in stock market, right? Like if you buy a share of Apple Computers or something, like it's not going anywhere, or like it's there, so some just things to be mindful of. So let's talk a little bit today. We're going to talk a little bit about where you're at with your trading right now. And then of course, answer these questions in the webinar chat box. Let's get this thing started. And by the way, guys, just so I have an idea of what you guys do and who you guys are, type 1 if you're just brand new to trading and hadn't taken a live trade before. Type 2 if you are trading but you've been just struggling for the last couple of months because the market conditions have changed, or the strategies that you're using or have learned have all of a sudden become obsolete. And they're not obsolete, but that just what happens is there's shifts every year in the market, and there'll be certain patterns that work or don't work. And then type 3, if you've been able to successfully adapt to the change in market conditions, meaning, as the market has shifted from bull to bear, have you actually been able to make your moves properly to capitalize on those things? So let's talk a little bit about just common issues that traders are facing in the current market. Some of the things that I've noticed of why traders are struggling right now. Number one is, this is happening all across the board. Like, you can go on like any single stock and you will see traders that were like making a lot of money, or making even some money or a little money, picking really, really low quality setups. Meaning, like, for example, if you're trading small cap stocks right now, if you notice on small cap stocks, like every single small cap stock, what happens to it? They spike up for a little bit and then they die. Like, it's an untradeable thing. And you'll see it like a million times with so many setups where they just pop up and then they die down, and they pop up and they die down, they pop up and they die down. And it's very, very hard to trade. Or they're trading in stocks that have really, really low liquidity. So if you look at like what's happened in a majority of, I would say, mid cap to small cap stocks, a lot of the ones, and you can pick any of your favorites that you're watching right now, what you'll notice is the volume has like died into nothing on them. The volume has died into nothing on them. So you don't actually have the liquidity to be able to get in and out of these type of names. What happens is, like, if you were making money trading these kind of things before, then all of a sudden, what are you going to be doing, right now? We never changed, so we have to change. So like every single stock that was like working, or type of pattern that was working on these kind of shitty names, they are all getting shit on. I mean, they're all getting shit on, literally. Those patterns aren't working. So what happens is, like, a lot of traders right now are picking either low quality setups, they're picking low volume stocks. So I would say, like, right now, you should be trading stocks that probably, I would say the minimum is 5 million shares a day. Like, if it's not doing 5 million shares a day, not even worth looking at. But ideally, like, you probably want them doing even 10 million plus for a lot of you guys. If you have a lot of experience trading, it's a little bit different, but I would go in with minimum 5 million. I would say 5 million. But like a lot of the stocks I've been trading recently have been like 100 million, 50 million, 20 million, so on and so forth. Because when the market is crashing, there's a lot of volatility in these stocks. Like, you don't have to really, you can trade like just really big name stocks, and that's going to be like that's the easiest way to go about it. The second part is like, and this is actually very common, because this pattern was working nonstop in 2020 and really 2021 and 2019 for a big portion of it. People were buying breakouts. So the essence of what a breakout is, for anybody that knows what a breakout is where you have like a resistance level or a lid on a particular stock. And, you kind of like run in and test that level multiple times, and you'll break over it. And so in any trading textbook that you've read, or anything that you've seen on the YouTubes or whatever, right? People will tell you, like, you have to buy when you break over these levels, right? That's called a breakout. But in this market, in the last 2 months, and this is actually very common, and it's been common for at least since I've been trading and watching stocks for 20 years, when you're in a distribution phase or a bear market, what that pattern is actually doing is that's like actually the spot where you short stocks. So what happens is, a lot of times, like, you're conditioned, because it's been working for many years, in every single trading textbook and pattern will say it. Oh, we have a stock that breaks out, so we buy it, but they all fail. So what ends up happening is like that breakout setup is actually like a spot that you're supposed to be shorting stocks, meaning you're betting on them could go down. So we're in like a little bit of an opposite day. But oftentimes you get conditioned into doing one thing, and so you just keep doing it. And usually you'll keep doing it till either you've lost so much money that you decide to make a change, or if you're just taking and you have like a really high quality trading journal, and if you have a really high quality trading journal where you have like really, really good notes, then you will be able to identify, hey, like when I'm doing this pattern, it's not working. When I'm doing this pattern, it's not working. So once you do it like 2-3 times, like, like, okay, I shouldn't do that. I have it in written word, like this is what's happening. And we'll talk a little bit about journaling in a little bit. And then of course, like this is also happening right now is like, with the market flushing a lot, chasing shorts. Like, you get a stock and it looks so hot, but you short it at the low of the day. And I made this mistake. I've been making this mistake too a little bit, but like, well, that is like that has not been working in this market either. Like, yeah, breakdowns are working and shorts are working, but you got to do them at certain times of day, but you can't chase them down when they're extended. I would say the big thing, and this is, my students know better than this. And I feel like everybody should know better than this, but nobody ever does. Counter trend trading. Counter trend trading is longing when the market is dumping. Longing when the market is dumping. So a lot of times when the market goes down, say 2, 3, 4 days, you think, whoa, I should be trying to long. That doesn't actually mean anything. Like that's a bull market tactic. In a bull market, if the market dips down 2, 3 days, you buy. This is not a bull market. So what happens is that's a lack of knowledge or lack of preparation. So now like what we're seeing in this market is like the market would dip down a few days and everybody's like, oh, I should be longing things. But yes, that is a valid idea if we are in a bull market, but we're not, right? And I think, one of the things to be mindful of is, and Danny, you can't be too hard on yourself. You haven't seen possibly this. You haven't seen like this current action before. So like this is a learning mechanism, but you just haven't seen this. Like, how are you supposed to act like oh man, I've been through like 50 bear markets, right? Like I've been smoking Marlboro Reds. I've been through 50 bear markets. Okay. I've been through the Bohemian Grove. I've seen the Clintons. I have seen things. And now I'm learning about bear market trading. Like you haven't been through all this stuff. Like I said, you got to just, this might be, you've seen it a couple times, like the coronavirus crash and stuff like that. You've seen stuff, but that was a very fast one, right? This has been like a real slow bleed. So it is a little bit different. So counter trend trading, guys, in general is really, really tough. You don't even really want to do it in bull markets or bear markets. Like counter trend trading it's like, anybody ever been to Hawaii? You go to Hawaii. So I went to Hawaii once, and I was on the Bumbler. Does anybody use the Bumble? So I'm on the Bumbler, right? So I'm on the Bumbler and I'm like, hey, like chatting with somebody because I was there for like a month, just hanging up on myself. So I'm on the Bumbler, and I'm like, oh, I got myself a little match. I got to go meet up with somebody. So I cruise in, I got a rental car. I'm cruising in and I'm in Maui and I'm in some hotel, like, where all the cliffs are and stuff. And I'm like, oh, sweet, man, I have a nice drive. But I drank too much water, so I had to go pee. So I stopped in at one of those little parks that like overlooks like the cliffs into the ocean, and it's super windy out. And I was like, I got to meet this girl in like 5 minutes. So I take a pee and it's windy out. And so I pee into the wind. And you know what happens? Came all back at me. It came all back at me. And that's what counter trend trading is. It is like pissing in the wind. You throw it out, and then you pay the price. You throw it out, man. And you know what? In your head, You're thinking like, this is a good idea. It's beautiful out. I'm in Hawaii. Nobody's watching. And I have to pee. And there's this beautiful cliff. Like, in a way, it's like, it's kind of cool. Except it was a little bit windy. And it came right back at me. And I had like a lot of pee. So it was like, and then you're like, when it's happening, you're like dodging. So then you're doing this. So now it's getting everywhere. Before it was just kind of getting back on my shirt, but then I started dodging and dancing it. So now it's all over my face and stuff. That's counter trend trading. It sounds good in theory, but it doesn't actually work because cheap gets cheaper, and it's always been the case. The second part of all this, and I've seen this is happening a lot. People aren't using stop losses. People aren't using stop losses. I did, Mazen. I peed on my face a little bit. I mean, it's like more trickles though, right? Like not using hard stops. This one I've struggled with for years. I don't know why. It's just a choice, right? Like fucking use a stop. So hard stop, for those of you guys who are brand new, is a messaging your software program that you trade on that says, hey, if I buy a stock at 100 and it goes to 99, sell me, right? So it's an automated risk management. When the market gets wild like this, people don't want to use these things. Why? Because the stocks are moving around so fast. 1 minute you're up 1,000, next minute you're down 1,000, and you're not really thinking the trade's out anyways. But like there's a lot of hopium that happens when the markets are crashing like this, where like, you have a position and you're like, oh, it'll get back there. It'll get back there. And that ends up just totally screwing you out every single time. And what hard stops will do is it takes the thinking out of the trade for you in real time. Meaning it's really easy to rationalize anything in this world. Hey, like it's the stock will come back. It's going to do this. My boyfriend will change, right? Like we can rationalize anything, but it doesn't mean it's actually going to happen. The hard stop is it allows you to take the thinking out of the trade for you so that you're not faced with the decision. Like when your stock starts to go down, or it's like, should I sell or not sell? Anybody ever been through that? Like, should I sell or not sell? Like you got a stock and it's like tanking and you're like, maybe I'll wait I'm going to wait like 5 more minutes. Right? Like, I'm going to wait 5 more minutes. Oh, but you know what? And then like you can rationalize it. You start looking and you start inventing support levels. So you'll start to be like, oh man, but it could go off here, right? Oh, it could do this. And then you start to look for reasons. You start to look for reasons to stay in it. And my biggest losses, I'll tell you, like my biggest losses in trading, and they've all been the same way. I have a stock, say I got a stock at like $50. Say it goes up to like $52 or something, right? I'm in a day trade. And then I'm like, I'm just being a greedy bastard. And so I don't sell it at $52. So then it starts to come back, right? And I'm like, oh man, like if it just gets back to $52, I would sell, but it doesn't. So now it's back at 51. And I'm like, oh, come on, go back to 52. I'm not greedy. Like I'll sell it. But then it keeps going down. So now it's at 50, right? Where I bought it. I'm like, shit. You know what? If it just gets back up to 51, I'll sell it. I'm not greedy. Like, come on. I need a little profit for my time here. And then next thing you know, boop, it's at 49. And you're like, fuck, I had all this. I was up on this thing. Now I'm not up on this thing. What the heck? Well, now it's at 49. I'm at a loss. I'm not selling at a loss because like if this happens, like if you, if any of you guys like follow like the AMC or GME crowds, like the stupidest thing that people say about trading is it's not a loss till you sell it, right? Anybody ever heard that? It's not a loss till you sell it. I mean, that's like the biggest bullshit ever. Hey, you have a net worth here. When these stocks go down, you're going down. So guess what? Even though you haven't sold it, it don't matter. When it goes down for 50 to 49, now you're down $1,000. And then, you know, how I go is this, I'll be like, oh shit, well, I can't sell it for a loss. Like when it goes to 50, I'll just get back out flat and I'll never do this again. I pray to the stock gods. I ain't never doing this again. I'm going to church on Sunday. I'm only drinking light beer from now on. Like I am going to change. And then it keeps going down for there. My biggest loss I've ever had just on the day trade side, I had like 5,000 shares. I was probably 13 years ago. So I was 26 years old, 27 years old. I had a stock that had this epic news out. I think it was Seagate Technologies, give or take. And it like had spiked up. I had like a whole crap load of this thing, crap load for my age, right? So like that was 20 cents. I probably had like 3,000 shares of this thing. And it had spiked up on some news. And I actually, it was just by blind luck. Like it had the news out and I was like, fuck. Like, and I was up like 10 bucks on it. So I was up like 20 grand on it. And at the time, right, that's like a lot of money. And like this thing started to go down and I didn't sell it and I didn't put my stop loss in, right? So like now I don't have a stop loss to lock in the gain. So then it just kept doing this. And literally by the end of the day, it had finished down $10. And I ended up, you know, being up 20 grand. You're right, Damien. No matter where you are in life, it is. And I ended up losing 20,000 bucks. And at the time, like that was for me, that was like, fuck, that was a good chunk of my account too, because I was using margin and stuff like that. But the moral of the story is like, if you don't use the stop loss, see what happened is like every step of the way, every time it bounced, and like stocks don't go down linear, right? So they go down and they bounce, and they go down and they bounce. So like every time it bounced, I was faced with the decision like, well, maybe it'll keep going up from here. And so like now you're going through this gamut of negotiations with yourself saying, well, it could go up from here. So I should hold it for a few more minutes and see if it keeps going. And then it won't. So then when it busts back down, I'm like, well, how much lower could it go, right? And so every single level, you're like faced with these decisions. So the easiest thing to do is what? Use a hard stop. Like now, for example, you know, if I'm in a stock, right, and I got it at 50 bucks, it spikes up to 60 bucks, I'm probably going to sell most of it anyways. But even if I don't, I'd probably put a stop loss in it like 59 bucks. So if it ever goes below 59, the computer will just sell me out, right? So like it takes that thinking out of it. I've gone through that gamut too many times because we are conditioned, you know, you guys all you all have goals and you want to take care of your families and do stuff. We all want to go for the home run all the time. Like it's a natural thing, you know, like you see it and you're like, man, this is like, I gotta get the home run out of this thing, right? And it just never works. So, you know, tell the computer what you want to do and do it. I do apologize for going a tangent on that, but I think it's important because, I mean, hot damn, it does cost me so much money for not doing that. You know, randomly averaging down or even buying falling knives, you know, expecting a bounce. And then, of course, you know, trading, and this is the worst one, trading bull market strategies, small cap strategies that aren't working in today's environment. They can't work in today's environment. So something to just be mindful of. There are 4 market cycles. There are 4 market cycles in the market. So like if you look at the market, you know, you have 4 market cycles. So let me regurgitate here. So your first market cycle is called accumulation. All right. The first market cycle is accumulation. So an accumulation phase is like after a big dump in the market, you'll get a sideways, I'm talking like a real bear market. You get a sideways action in the market for a period of time where buyers and sellers are at equilibrium and, you know, the market just refuses to go down. During this time, like your moving averages, your indicators will all start to flatten out. During this phase, it's called accumulation because even though like the momentum traders, the day traders, people that need like, right, some heat to get going, they can't really trade it. But like if you're a big fund or a big investor, these are good times because you have cheap prices. So that's called your accumulation phase. So like if you were doing a momentum trading strategy while the market is just sitting there accumulating, not doing much, would they work? No, right? Then the next phase of the market is called a run-up phase. So a run-up phase is your good old-fashioned bull market, right? A run-up phase is when, right, there are essentially more buyers than sellers. So there's a fight for liquidity. All your indicators, your moving averages, everything start to point up. During this phase, if you're using very, very aggressive trading tactics and trend trading strategies, they would all work. During this phase, also, you could take on more risk. If you are even, just randomly buying dips on very, very good stocks and trending stocks, they tend to work out, even though that's not like a really sound trading strategy. The strength of the market will essentially bail you out of bad trading decisions or lazy trading decisions. And so that run-up phase, that's really what can get people, because during that phase, you can make mistakes and still get paid. And people love that, right? So it gives you that false sense of security, like, hey, I actually know what I'm doing. So in the run-up phase, you want to watch your moving averages, your 9 EMA, 20 SMA, so on and so forth. As long as they're pointing up on those things, then you are in essentially a bull market. So if you go in and, if we're looking at like just a particular stock of things, hold on here, let me get some charts over here. So like your run-up phase, so this is essentially what I'm talking about, if we're looking at like a particular stock. So like this is your run-up phase, right? So like this is your accumulation phase. So accumulation phase, like you get this sideways movement on a particular stock, right? So like, see, there's really no action. Like you can't really trade it. You can't really do anything. It's just sitting there and it looks cheap. So, oftentimes like you could see like, right, bigger traders or bigger funds or somebody, messing around with this because it's cheap. But then what happens is the next phase is this is your run-up phase. So in the run-up phase, like a stock is starting to trend. You'll see your 9 EMA like really starting to curl up. I use a 9 exponential moving average as just a way to gauge trends, but also it serves as a way to manage support and resistance. All right. So that is going to be something to also just kind of keep in the back of your head. Now, what do you start to see like after that happens? So what you'll start to see is like, okay, run-up phase, this is your bull market. Then after a while, like your market starts to peak out. So what I mean by peak out is like, okay, you don't go up forever. Like this thing is at like $100, it goes to $400, but then your moving averages start to cross over. Like all of a sudden, like every bounce on it gets faded off. So what ends up happening is you get yourself in a distribution market. So what a distribution market is like the market is near highs, but the big hairy butt of it is that, hold on one sec. The big hairy butt of that is that it's not going to be bouncing. There's sellers that are coming into this thing. And Damien, I use it because it just works. I think works for me. I don't have anything scientific on it. It works. And then after the distribution phase, so the distribution phase is like a topping out phase where the market or a stock can't get any higher. And then you start to run down into your rundown phase. So the moral of the story of why I trade like this particular, why you have to trade in particular ways is that the trading strategies you would use here, if you're a retail trader, like that's us, well, there's nothing we could do here because it's just stuck, right? Like that's for institutions, mutual fund managers. I mean, you could purchase in there, but you don't know how long it will just go sideways. So like the trading, oftentimes if you were doing a momentum strategy, which is like what is written in, so many trading books or what a lot of traders would use, if you use a momentum strategy during that time, it would not work. There would be almost none of your trades would work. And then, like you may give up and then all of a sudden, right, like during this phase, you can do breakouts, you can do pullbacks, you can do flat tops, you can do almost anything and it will work as long as you're managing your risk. So like now the market has shifted. But the strategies, if you were doing them here, they would not work here That's your distribution market, your topping out phase. And then, of course, you have your rundown market. And that's what we're in right now in the market. In any given stock, any given name, we are in a rundown market. So rundown market is your bear market. Your 9 EMA, your 20 SMA, those are your 2 short-term moving averages. They will be pointing down. They will serve as resistance points, areas that get faded off. And it doesn't matter what stock you're looking at. Like, this is a bear market. So this Affirm was the hottest stock around, right? It's $50. It's almost $200. Like, we were trading this thing every single day for months because it was trending higher, right? And if you got a stock that's trending higher, that's it's a godsend. And then it started to roll over. And so now we've been literally traded every single day to the downside, but it's already lost like 75, 80% of its value. But if I was doing here, what I was doing here, would it work? No. But if you just did the opposite, right, which is like shorting stocks using this. So whatever patterns you're doing here, if you just flip them and you're shorting them using the same strategies, then it would work. And you can see like it just keeps fading off and it's moving averages and so on and so forth. I'm going to teach you actual couple, day trading strategies, some patterns that you can use. Just be mindful with me because I think these market cycles are very, very important. So just something to just kind of be mindful of. I went on a tangent a little bit, but I tend to do that. So how you want to trade this current market environment? You want to, first of all, pick high quality setups. So you want to have high relative volume, strong daily chart that trends with the market. So what I mean by all that, first of all, is, let me get back to these slides here. But when we're talking about this market, we want to pick high quality stuff. So you don't need to worry about price of stocks right now. A $5 stock and a $50 stock will move around in the same percentages. In a bear market, everything crashes. Every stock will go down the same. It's called the rising tide lifts all boats, and it's the same thing in reverse. So when the market's getting shemangled, they're all going to be down quite a bit. You don't need to care about price of stocks. They're all going to move down a lot. So you want to pick stocks that got a ton of volume. They have a strong daily chart. So like right now, because the market is in a bear market, a strong daily chart means what? Not a stock that's been going up, because there are none, right? A stock that's cleanly trending to the downside. So like, I want to be day trading and swing trading, right? These kind of names that are cruising to the downside. So like, this is something, right? This is a trending stock. See how much volume it does? So like, these are, things that you can actually trade back and forth. Like this AMD, I trade this AMD quite a bit every day, actually, right? Like this is a trending stock. See how it's just kind of following down its 9 EMA here? This thing's doing 125 million shares in volume. Like, you have enough liquidity to be able to get into this bad boy, right? So we want to be trading these kind of trenders. You don't even need to mess around with it. Like, these things are moving around so much. The amount of research you have to do in this type of market compared to a hot market is minimal, because they all move around the same. Your watch list can be smaller, more focused around large cap liquid names, because they will move around 10% plus per day, every single day, up and down. So like, if you think about, like, even if you have a lot of people don't want to trade, like, say, an $80 stock or $90 stock, it doesn't matter. If you're only trading, say, 100 shares of this thing back and forth, they're moving around $5, $10, $15 back and forth every day. So like, you could trade even a small amount of shares and still take the chunks and make money, as long as you're willing to take the chunks. $2, $3 here, $2, $3 there. See, a lot of times people think it's the percentage gain that really matters. And so that's why they gravitate towards cheaper names, because they think like, okay, percentage gain. But like, if you have a $2 stock and it moves around, say, 10%, for example, right? That's 20 cents. Well, it's really hard to trade back and forth within 20 cents. You know what I mean? But you know what is easy to trade around back and forth? $10. So like, for example, this is an intraday chart of a firm, for example. This is a $50 stock. So like this is a $50 stock, but it's got great range on it. So you have like a stock that like it started the day at 58, it ended the day at 48. And like these are the ebbs and flows of it. Like it moves really clean. So like if you have a smaller account, what's easier to make and more likely for your long-term growth to actually make you money? Trading something small, whether it's a 50 shares, 100 shares, 200 shares, whatever you can afford, of something that's moving around $10. And like, you're not going to have any weird, right? Like weird things that happen out of nowhere, like you do with, like a very low market cap names. You can come in and see the patterns easier. See, if a stock is $2 and it's just moving around 20 cents, and you're trying to spot patterns within that, it's really hard, right? But if you have something that's moving around $10 and you're trying to spot patterns and trade back and forth within there, then you can. So like, like this Roblox is like a very, very similar thing. I've been trading this up and down for, quite a few months, but it moves around like, okay, today it moves around 10%. It's like, you don't need to trade like a whole lot of shares. Like, as you get more capital, of course you can, because they're liquid enough. Like you could trade 10,000, 20,000 shares of this if you wanted to. But when you're new, like you can come in, trade 100 shares, 200 shares back and forth, and it's got a nice solid range to it. And so what happens is you can stack $100, $200, $300 at a time, and you kind of do it over and over. And that's really how you grow your account. So many times like we get suckered into things because you see on the Twitter, and it's really like the Dogecoin that really got everybody going. But once that Dogecoin started to really like get crazy, and you're hearing all these stories of people like, oh, I bought Dogecoin at 1/10,000th of a penny, and so now my $1,000 is worth $1 million. And it's true, there were a handful of people that did that. What happened is like, when that started, then everybody was like looking for that. And they forgot that trading is just a job. It's no different than going to your job to do anything. We're looking to take income out of it. And we can stack a lot of income if we keep taking patterns, good patterns over and over. So that's why we want to trade stuff that's just got good range to it, because you can, even if you just trade 100 shares, man, you take $1 here, $2 here, and you keep stacking that thing, that's good money. That's good money. So many times we have expectations of things before our skill level and our experience, and of course our capital are reflecting that, right? So many times people have these crazy expectations because they either have bills or they just are like, oh, I want to do this because I see other people doing it. So they have these crazy expectations, and they don't get in the habit of just taking gains all the time and building it up. Because if you go, you take it $100 here, $200 here, by the end of the day, you're going to have 500, $600. Guess what? That's good money. It's not sexy, but damn good money, right? Like you got to work a lot in the real world to make that kind of money. And so that's what's very, very small shares. As you start to grow, like when I'm trading this stuff, I'm trading usually 2,000, 3,000 shares of it. You can, right? Start to scale it up as you start to go. So, pick these high quality setups. You don't need very many names in this market. I mean, you can go in, really trade the same 10, 15 names for the most part. We're also in the earnings season, which allows us to expand our watch list into more momentum names. If there are stocks that have like good earnings out or some good news out. We haven't seen very many yet. Today, Apple's supposedly popping up on their earnings. We'll see if it actually holds. This is in this bear market, like nothing's been holding. So I'm not that keen on trying to buy Apple computers, but we'll start to see. When you do long on this market, you almost always want to do it on supports and deep pullbacks versus trying to buy breakouts. It just hasn't worked. And then, of course, like when you're trend trading, and I'm making this mistake a lot too, is like waiting for the market confirmation to show us which direction the market's going to go to. the biggest bounces in the market ever are also in bear markets. So like the biggest up days are also in bear markets. And so what you have to really do is let the trend set. Sometimes like we can come in the first few minutes and we want to trade some names, and how often do we you get shaken out all the time because you don't actually have a trend set. So oftentimes like just waiting 10, 15 minutes at the open will give you kind of a clear direction, a little bit more of a clear direction, a little bit more evidence of what is happening in the market. Now, I love trading the open. So like, I don't see myself ever waiting 15 minutes to make a trade. I usually, I like to start layering in, and I usually got a good guesstimate just based on years of experience and patterns of what should happen. But oftentimes I'm wrong and we have to change these things around. But I have noticed in the last 2 weeks, like if you wait even 15, 20 minutes, the trend starts to set, and it's been a lot easier. It's been a lot easier to see it after. And if you really look, like even like, for example, like this has happened the last few days. Let me go back to this, but like I use the QQQ index. And guys, by the way, if this is like just over your head and you're like, what the fuck's this guy talking about? I'm brand new. I got like intro courses and like just beginner stuff that I'll gladly send to you for free. And then come back and watch this one. It'll make a lot more sense. But like, this is what I'm kind of talking about. This has been happening a lot, so like the market kind of shreds up a little bit and then you're thinking long, but then, it took a little time. And then the trend set, and then every bounce is getting faded off. And just because of, you break over VWAP these days, that doesn't actually mean anything. If you're just a lower high, lower high, lower high, you'll start to speed up. But like, this is where you really want to take part, is when you start to speed up. So like when the MAs start to curl down or up, that's when the speed up happens. And you'll often see a crossover, Danny, where you'll see the crossover happens both to the upside and downside. That's when the speed up comes in. And that's when you want to really start to hammer everything. And then at that point, you can take every single pop and short. And once that speed up happens, you don't want to try to long anything in these. You just short the pops and let it go. But that's been happening like every day, quite a bit. So you want to like really be just mindful of these things. Like you can see here, like, a lot of these days, like, if you got to let the trend set, like Danny, what I'm talking about is like, see here, like when you get the crossover, that's when the speed up happens. And that's really your easiest trade. Like obviously, me, like I'm not going to wait till 2 p.m. But like for yourself, like the speed up is where you want to probably participate if you're hanging. So watch like those MAs, like when they're kind of pointing straight down or up, and that's when you want to come in. But anything sideways, like leave it alone. But you're really seeing like the first 15 minutes have always been, first 15 minutes, hour has always been really, really tricky. So just something to be mindful of as you guys are looking through this stuff. So let's talk a little bit about some risk management tips. And before that, one thing that I've been noticing, so like, if you're looking, there's no swing trading in this market, for example. All right, there's no swing trading in this market. It hasn't worked. It shouldn't work. Like it's a garbaggio. Like you just don't want to really do it. This is a day trading market only, but a couple setups. I'll tell you a setup that's been just working like a charm for me all year has been, we call this a 20 EMA short. So I use 5-minute charts on my intraday charts. And what we call a 20 EMA short is, when you have a downtrend, and this will happen a little bit after, like a little bit post, the morning. But when you get like these stocks that start to trend down, what you want to do is then make sure they're actually down a little bit. So like I would say like at least 1 or 2% before you start to look at like trying to shred them to the short side. But like when you get like these big flushes, it's easy. It's hard to try to figure out like where to get your re-entry. But when they pop into the 20 EMA, so that's your red line here. When they pop into the 20 EMA and you want to get a red candle to hold, like that has been like a bread and butter setup. So, you short there and put your stop over and take it into the flush. And it's been working, I mean, like a charm, like pretty much nonstop. I took this thing again today, into the 20 EMA here, and it popped down like a buck. I covered off half and I got stopped out of it. But as soon as like it popped back over and it broke back under, like you can reshort this thing and like you get a nice flush out of this thing. And then what happens is like you don't want to short lows, like let it just pop back in. So like when it pops back into the 20 EMA, you want to do this after 11 a.m. When it pops back into that 20 EMA, you just shred right into that thing. It's been working like a charm. The thing is and by the way, when it starts to turn up, you have to leave it alone. So like you need that thing turning down. Like that has been, man, that's been a bread and butter for me like so many times. And all these stocks, like any type of like these big downtrend days, like when you start to get them, like all these kind of pops into the 20 EMAs, like they've been working like nonstop. I've used it so many times. The Roblox, it doesn't really matter, but what you want to do is just get a red candle to hold on these things. And so like you get the flush down and you pop into them. Once you get that red candle to hold under, then you can come back in hot. And you do want to give them like a little bit of room, but hot damn, like you can do this like pretty much all the time on downtrend days, only on downtrend days. And like, if you get stopped out of one, who cares, right? Like, so like you get a flush down, right? You pop into the 20 EMA, you get the red candle to hold, and like, see how like you just kind of keep bouncing into these things, these wicks, like see how you get a big flush and then you boom, you get this pop in 20 EMA, they immediately reverse back like pretty quick. So, for me, like, okay, as soon as it grabs into that 1,000 shares and, we'll see like what goes down. And what you want to do is stay away when they flatten out like this. See how like it flattened out here? Like when they start to turn up, like you want to leave it alone. Like you want it only pointing down and then it's good to go. So like you see when it turns up, like they tend to bounce, but then like it reverses back, of course. And now all these pops into the 20 EMAs, like they're getting faded off again and again. I have been using like this damn setup like nonstop on, any kind of stock you can think of. Fucking SoFi, sorry for the swearing. SoFi is like another one. They had a big breakdown here at 11. And like same type of deal. So you get this breakdown, boom, pop into the 20 EMA. You want to have that red candle hold, and then you get down. And then boom, pop into 20 EMA, flush down. Like you can keep doing these. Man, you can keep doing these quite a bit. Like I've taken like snapshots of like some of my trades, and I mean, I've seen it. I think I took like 12 of them today. Like there's quite a few that start to show up like when that trend sets, and like look like regurgitate on the charts any big down day, and you'll see like huge amounts of them nonstop. Yeah, it's kind of cool. If I could turn back time, if I could find a way. Good. Well, that's a good question. So, account size is, in a lot of ways, yes, when you have like, say, $10,000, you're not going to make as much money as you would if you had $100,000. But I would say like most of my students start off fairly small, and then they kind of grow their accounts into it over time. But it is like, yeah, because we're not depending on, like some big time small cap gainers, like, right, this is like more of a steady income style of trading. Yeah, like you got to have some capital. But I would say, yeah, we teach swing trading and day trading in ours. And the strategies I use, like you can also use it for cryptocurrency. Like I'm day trading short and long cryptocurrency right now in our cryptocurrency chat room using these same strategies. So if you have like smaller capital, you start trading the cryptos. There's no pattern day trade rules, any of that stuff. And the patterns are literally like, the patterns are the same. Yeah, the cryptos move actually a lot cleaner They move a lot cleaner some days. Yeah, they really do. Somebody was just saying on the 14th were these 20 EMAs. Let me see. Dun, dun. Yeah, so like this is like you're reading this, right? So you get a right like shred down, pop into the 20, that's your red line, pop into 20, pop in 20. Like you can use that as essentially a short signal and cruise into it. If you have a smaller account, I would go in and just trade cryptocurrency most likely. Yeah, and I would stay away from options, penny stocks, any of that kind of doohickeys. I think, is that the proper term? Doohickeys? I don't know. I would stay away from all that stuff. Like you want to be into things that like actually are scalable, that can give you a chance to make money. They give you a chance for long-term survival, unless you are in it. Like, look, if you are in it for a get rich quick with no skills and no work scheme, then yeah, I would roll with the pennies and do all that stuff. Because, there's a time and place for that too. Shit, why not? There's a time and place for that, but the percentage of likeliness is very small. But if you're thinking like, hey, I'm looking at this for the next 10 years, 20 years, I want to build my retirement accounts, I want to build my long-term accounts, I want to make some income, I want to have something steady, then you have to learn it the proper way. You know it, Andy. There's never a time where I ain't going to be in some trades at the open. So now let's talk about staying on top of your risk management rules when you start to transition. You don't have to trade everything and anything all the time. There are times where you can just sit around and wait for really, really good entries while timing the market. So meaning like if you don't have a good read on the market, you can just sit there for a second because a read will come. When you think about like trends and what enables trends, it's really just a matter of higher highs, higher lows, and then your moving average is curling up. And when they're flatlined, right, you're in a trendless day or trendless market. But like we always want to be trading, so oftentimes that's when we start hitting things. But like you don't have to. You can wait for the trend to set. One of the things I'm really good at is like even just scalping back and forth for like 50 cents here, back and forth inside ranges. And I can do that like all day, but like that requires like a very, very right specific type of mindset to do things. That type of thing is not for everybody. Some people need to see very, very clean entries and trends. And if you just wait it out, look for your 9 EMA, look for crossovers, and then look for the speed up, then you're going to have much better entries. Oftentimes your hold times are going to be shorter. One thing to be mindful of is you got to be a little bit patient at the open. There's been a lot of dipsy-doos at the open. Dipsy-doos is like, you think the market's going one way and it goes back the other way. And then, of course, hard stops on everything. Sell portions into the first spike and then trail the rest over your moving averages. How do you know when to go long, short, long, short? Like, how do you know which directions to pick? You always want to check the areas where the QQQ's overall market can have resistance and support areas. But you also want to think like in common sense terms. So if you think of like common sense terms, if you get a multi-day bounce, in the market, but you smack into a moving average, that's usually a spot to actually come back and short. But what happens is because you had a multi-day bounce, people feel pretty good about the market, so they keep buying. And then the rug gets pulled. Remember, in a bear market, spikes get faded, not dips get bought. It's the same thing, just in reverse. So you want to check like where your overall levels are in the QQQs. You want to also see like what was happening the previous day. What's the high of the day, low of the day, and any major support and resistance levels. Then you got to assess the pre-market gap. Is it a light gap? If it's a light gap and you had a trend day the previous day, then you're playing for red to green, green to red based on that previous day. If you have an exhaustion gap, which means like a big, big gap followed by multiple down days already in the market, that could exhaust all the selling, and then you could get a quick counter trend trade. And then, of course, if you have strength in a bear market, and you've seen this now, like how many times? You have strength in a bear market. What I mean by strength in a bear market, and this is where it gets people. So even in my boot camp, right, I teach my students, like when we have a gap up on something, a gap up on a stock, for example, it's a bullish thing. And it is in bull markets. But in a bear market, it's the opposite. So like what I mean by that is, like, for example, in a bull market, if we had a stock like NVIDIA today gapped up today, all right? Now I call that a sucker's gap. So what I mean by that is, like, in a bull market, we actually look at those gaps and we want to try to long them. We want to try to long them. We want to wait for a pullback or some opening range to develop. And we actually try to long these things. We actually try to long these things. But in the bear market, that's called sucker's gap. So what I mean by that is, like, if it gaps up and then it just like runs into like resistance, they always fade off. It always, in bear market, that's a fade spot. In bear market, that's a fade spot. So that's a long setup in a nasty market, but in a bear market, it becomes a short setup. So we want to assess where these gaps are and then really think about, like, hey, where are they opening into? So when we think about the opening in terms of the indexes, we want to look at the indexes in a really, really similar manner. So what I mean by that is, like, if you look at, like, say, the QQQs, for example, a couple days, yesterday, like, see how, like, you kind of spiked up right here? And so, like, we had like a big update in the market. And then, yesterday into the Fed, we had like a little bit of a spike up after the Federal Reserve came out with their news, but it just ran into the 9 EMA on the daily, and then you completely ran over. And that's happening all the time. Like, if you look at these previous days here in January, like, you had a nice bounce and everybody's thinking the market is like all hunky-dory. Nobody uses that term anymore, but they should, right? So, like, you had a nice 3 days over here, but you ran into resistance. Look how big the down day was. You just ran into resistance, and then it's rug pull. And that's been happening a lot. Like, you get 3-4 up days, and then it's a rug pull. And so we want to be assessing based on what the QQQs is doing and where the support and resistance areas are, and then start to pick directions. And the majority of the time, obviously, it's just been shorts because we're in a bear market. Now, however, we still need to monitor price action at the open to confirm direction of the gap and what type of intraday trend we will have afterwards. Hey, Aaron, what's up, baby? Yes, I don't use MACD or RSI because I use the stochastics because I'm looking for overbought, oversold. RSI is not really effective for overbought, oversold because it's actually a relative strength indicator. It's meant to really, theoretically, it's meant to spot divergences, not necessarily overbought, oversold. But there was one jerk, and I won't even name his name. There's one jerk who wrote a trading book like 10 years ago, and he thought he must have not had an editor. I doubt he trades, but he put in like, hey, RSI is how you look for overbought, oversold. And then everybody started talking about it, but that's actually not the case. So let's talk about when to go long, when to go short. So if you look at the day, the market broke recent lows and it bounced hard in the afternoon, we can see like how NVIDIA has a great range and trades alongside the direction of the tech index for a majority of the time. So when we have confirmation from the market, we can apply our intraday setups that we teach at our boot camp for all of these things, whether it's ORB, pullbacks to VWAP. I've got 18 different trading patterns that we can use. They don't all apply to every single market, right? There's 4 different market cycles. So I have different trading patterns for different markets, but we have a whole host of them that oh, my bad, Josh. We have a whole host of them that we teach, in these bad boys, but we really do want to line up where the indexes are, where the stock is. And that's really how we start to try to trade these things. So when we're thinking about when to go long or short, like this is something we were trading off today. When the QQQs are busting down, that's your general index. That's when we also are starting to take our stocks down at the same manner, looking for trading patterns. So you can't just blindly take something down. You want to start looking for trading patterns that start to go up. So the focus has been mid, large cap tech, auto, consumer stocks, no small caps, and tech. We've really been trading a lot of the same names over and over because they have the biggest range and the most liquidity. Out of 8,000 stocks in the market, probably only 100 are worth a damn right now to actually even look at. And I would say maybe only 50 of them are even tradable, which is kind of awesome because it makes your homework a lot less. In a bull market, there are stocks that are like hidden gems and things that are coming out of nowhere. And so in bull markets, we got to do a lot of research, and I use software and stuff to find the names, but like you're spending a significant amount more time hunting around and looking for stocks because you got to go through and filter through 8,000. But in this market, there's really only a handful that are worth a damn to trade. So it ends up being pretty cool. Like we don't got to do much. And the good thing is like while I'm trading today, I'm live. I'm on Zoom. I got a Discord room. I'm like typing in what I'm doing and selling and letting everybody know. But I'm on Zoom. I'm hooting and hollering and singing and dancing the whole time. Same type of deal. When to go long or short. So if you have the QQQs, you start to break down, right? See how like you start to bust lower and start to speed up? That's when I'm loading into shorts. Like I shorted this SC here right around 134 and some change. But like I waited on this till I started to see the market start to speed up. I wanted to see that 9 EMA really coming down on it because I knew it would speed up the market because the market was showing some like fake outs where it looked like it was getting heavy. But like that, see how the 9 wasn't curling down on the kitchen on it? So I knew that there would be no speed up. So like I abstained from shorting till that speed up started to show. And then you put the wood down on these things and time them. So what to do if you're currently trading, but you're struggling? And we all struggled before. I don't even tell you about, my mentor, Paul, teaches classes for us too. And I mean, the things that he had to go through to get my head straight is beyond me, to this day. Now I'm always barking at him, but he'll remind me at least once a week. Hey, come on, let's not forget 2006, buddy. Shit, we all go through it. We all struggle. The big thing is to keep making adjustments nonstop. Make adjustments. Something's wrong, dissect it, make an adjustment. Focus on charts. That's everything. And matching the trend of the market. Mid cap, large caps move cleaner. They're more liquid. Find a set of entries and exits, meaning a checklist. Every trading pattern should have a checklist. So like a 20 EMA pattern, right? Something we talk about. There's a checklist for it, right? You need a spike to go down, stock to go down at least 1 or 2%. You need at least one test of the VWAP. It comes a little bit later into the morning to the afternoon after a spike down, so on and so forth. Like you'll have like very, very specific rules for every single trade. If you have a checklist, a sticky note, something, a recipe on your trading strategy for the patterns that you're going to use, then when things go wrong, you're actually going to be able to look at it and start taking things out and adjusting them. But if you don't actually have that recipe, you don't have a checklist, you haven't built out a business plan for like what you're trying to do, then what happens is like when things go wrong, you have trouble and will have trouble making adjustments very quickly and in real time or in a short period of time because you just don't have the proper documentation, notes, plans that you need. And most people that struggle or don't make money, they're just button spammers. What I mean by button spammers is, stocks are going up and down and they're just clicking buttons with no real sense of plan, strategy, checklists, anything of that nature. And by the way, you don't need all that stuff for every single trade. I have trades I screw up every single day, but usually it's when I'm not following those things. But like, you could screw up more times than you're right and still make a lot of money. So you got to build out those plans and checklists and different things on how to get your proper entries, because that's where you're going to actually make some progress. So focus on eliminating those trading mistakes. Trade with any type of community, whether it's mine or somebody else's. If somebody's good, they're good. Somebody you can bounce ideas off, get feedback from, call, chat with, DM, right? Send dirty pictures to, whatever. I'm just kidding. But like, you got to have the ability to chat with somebody. I have had probably, I would say in the last 6 years, I probably had 500 students over the time I've been in this place, stay at my place here and hang out. Like, at some point you gotta come in and meet somebody. You gotta come and meet somebody, call somebody, FaceTime somebody, and get your shit done. Then of course you want to learn how to trade all market cycles. We're in a bear market right now. Last year we were in a bull market for a lot of those times. But guess what? There's other market cycles. Just many people haven't been exposed to them because the market's been running one way for so long. We're about to see every single market cycle, because when the market is done being a bear market, it's not going to just start bouncing and going straight up. Most likely, it's going to go sideways for a long period of time. A lot of these stocks are going to go sideways for a long period of time. Like, when the bear market is over, they're not just going to start ripping back up. There's going to be a period where they start to go sideways, and you'll have to have very, very specific trading tactics to get into those names. Good. So how to develop yourself as a trader after tonight? Surround yourself with good traders. Whether it's like just people in this Zoom, people that you meet. Like, I have met one of my business partners. I met him on Twitter. Josh, that you see here answering questions. I met him on social media. Like, he was one of my students when he was in high school, like many, many years ago. And I met him on social media. You can find yourself successful traders. You got to reach out and do what you got to do. Surround yourself with smart people. That helps. In our community, we've got students that have been there with us for 12 plus years a lot of time. So it ends up helping to just have people that have experience that you can chat with, exchange ideas with. We also do, we do class 4 nights a week. So we're always together. And then I'm trading in front of the students live every single day. So we're pretty much all together. Like, we have class at night. I'm trading in front of them during the day. We end up having we end up having a lot of time together. And of course, we go in and we recap our trades. We get on Zoom and talk about what went right, what went wrong on these trades, and really kind of dive in and how to get better. I think that's really important. You can be trading live in front of people, but if you can't discuss what's happening properly, then like, where is the lesson to be learned, essentially? And if you haven't, you need to build a trading plan, right? You wouldn't go to a bank, right, ask for a loan and say like, hey, I want to get into this business without a business plan. And your trading is the same thing. You're the CEO of your own small business, and you try and take that thing into a bigger business. So we got to build out trading plans. And these are things that, we'll all do in the boot camps together. So know how to adapt is just one piece of the puzzle. Our course that we do is 60 days long, from A to Z. So there's nothing left after that. Whatever I got goes into this class. And it's for day trading, swing trading. So swing trading is like holding stocks for multiple days to weeks. We go over all of it, and we do spend equal time on it. So it's not something where like, this is a day trading course. To be able to do day trading, you have to know how to swing trade. To be able to day trade, you have to know how to swing trade, because you still look at those bigger picture ideas to get into your day trades. And that becomes really important. So you want to you need to learn how to do both. But the other thing is, you've got IRAs and 401ks. Like, you do need to learn how to do longer term trades and longer term trend analysis. And that really does help also with your day trading. So you have 20 live classes via webinar. I teach 18 different trading setups. I know that seems like a lot, especially considering like probably most people online know like one thing. But if you really want to like attack the markets like a hedge fund trader would, you need different tactics and strategies that you can use in any type of market. Now, on any given day, like tomorrow, like when I wake up, I don't have 18 trading patterns I'm doing. Remember, there's 4 different market cycles. There's only a handful that work in every single one. And so these are things that, we kind of go over, both day trading and swing trading. And guys, everything is recorded. It's archived for you. You can play them back and you have lifetime access to it. Like my students in this next class that starts February on Halloween, not Halloween, Valentine's Day, day before, I'll have students in there from 10 years ago. They'll pop in, say hello, ask some questions. So it's kind of fun. Like, we have a tight-knit community, but you can retake class as many times as you want. And so you'll have access to the recorded versions and also the past recorded versions. You want to look at the last boot camp, the boot camp before, the boot camp before, they're all on there. But then like when I'm doing live class, you can come in every single time. I'll have people like Miss Priceman and Mr. Hassman and so on and so forth. They'll come in every class they can give because it's just part of their routine. Even if you don't need necessarily to learn anything, it's just part of your learning routine. Hey, teachers doing class, I'm gonna pop in and say, hey. We do have every single class Q&A sessions, quizzes, homeworks, all that kind of stuff. And then, when we're done with class, I'll show you how to get on a trading simulator. You're going to start to click the buttons too. Build out your trading plan, click the buttons. We'll go into how to journal these trades properly. I can take a look at them. There's ways that we use TraderView so that you can actually go in and share the trades. And so it's kind of fun. Like you can go in, we use this software. Yeah, I can see everybody's trades. So these are like, these are either new students or students that are trading live, but they're just like new. I can see like what they all do. So like I can see like Jay Joshi, the legend. Like I can see like some of his goofy trades, like this. And so I can bark at him, but also like I can, come in and leave comments on these things. So I can see the details of every single trade here. And then like, this is actually probably his best trade. Like he shorted into his gap over here, but he covered early. So like I can come in and leave comments. So that's kind of fun. Like you can come in and I got a whole host of these people, Miss Laura, Miss Kathleen, and so on and so forth. That's where you really get better, right? Like if you can talk with somebody, and it doesn't even have to be me, but if you can talk with somebody, they can look at what you're doing and say, no, that is not good. Then that's when you're going to be really a lot better. And of course, we got, course books and all this kind of stuff. You do get access to our chat room to watch me live stream and hang out with everybody with the boot camp. So while boot camp's going, like you're going to have that ability to take what we learn at night in that book knowledge and turn it into real life application. You're going to see me shred. You're going to see me shred these markets every single day. And some days I get shredded too. So I shred some days I get shredded. But we talk about those things. So guys, if you have just any questions, first 5 people will get the extra 6 months in the chat room, $24.99. We start the day before Valentine's Day. If you have any questions, like you just want to chat with somebody, my business partner, my childhood best friend, Omer, his number is 972-841-6494. You can put in your name and number in the chat box. You can just put panelists, send it to the panelists so nobody can see it. I'll have Omer or myself give you a call, or Josh, you guys are already chatting with them right now. Well, one of us will give you a call. We can do literally like a little trade analysis to see where you are, like with your trading, what your goals are, and try to figure out like what we need to do next. Guys, we also have payment plans available. So you can just put in your email number. We'll give you a call and we'll get you all set up. We got class in 2 weeks. I mean, that's going to be a good time. That's going to be a good time. And if any of you guys just want to chat with a student or something like that, you want to chat with somebody that's been working with us, let me know, man. I got a whole Rolodex of people that have been doing this with me for a long time. And frankly, a lot of the trading businesses that you see online right now are all from this class anyways. This was one of the first ones. I started doing these boot camps in 2008. So if you guys ever want to reach me, this is me on the Twitter. That's my cell number if you ever want to chat. And you let me know. You let me know if you ever want to chat. That's actually my actual cell. So you can text me if you ever have any questions. You just want to chat, or if you had a bad day or whatever. It don't matter. Let's open this thing up to some questions. If you guys asked me like an hour ago, I may have not seen it, or I wouldn't have seen it. So if I just missed a question, if you just ask again. Keon, what up, baby? Thank you, Fernando. I appreciate it, brother. I know you guys probably been to a lot of webinars, and a lot of them are no buenos. A lot of them are no buenos. Tony, I think we could probably, we can figure something out, Mr. Curia. I wouldn't, if you want to come in, I'll figure it out for you. Mr. Damien. The next one will probably be in April, May. Later, Eric. Good. Hey, you know what? I've traded futures before too. It's pretty linear. It's really no different than trading like ETFs and stocks. Futures is one of those things. It's a lot of leverage. If you're going to trade futures, I would do the micro futures, which is like 1/10 of a futures contract. My first day I was trading futures, like just randomly somebody was trading them. So I was like, oh shit, let me open up put some money into my futures account. And I didn't know anything about futures, but I've been trading stocks for so long, and patterns are patterns, but I didn't realize like how much leverage they are. And like, I just put like, maybe like 10 grand account. And it was like, by the end of the day, like I've been just like balls deep on all these like futures trades. I'd like turned that 10 grand into like 30. And then the next day I like literally lost it all. Like I didn't realize what was going on. There's so much leverage in there. So like, I think futures is okay. The one thing with futures is in a bear market like this, futures is really good because you have a lot of range in the markets. In bull markets, the market volatility is really low. So when you're trading futures indexes, they don't really move a lot in bull markets. So that's where I think, like right now, I think futures trading is hot, but it may not be hot. It's never hot in a bull market. At least for day trading. Yeah, Damon, we do class Sundays, Mondays, Tuesdays, Wednesdays, 2 classes on Sundays. And then 9 a.m. Eastern time till I'm done trading. Could be noon, could be 3 p.m. I'll be on the Zooms. I'll be trading in front of everybody, doing what I got to do. Cool. All right. My friend, it's been real, it's been fun, and it's been fair. Cool. All right. Later. Take care, guys.